Welcome to Closing Bell. I'm Scott Wapner. Let's show you the markets right now. They have been extending their record highs today. The S&P and the Nasdaq on track for new closing highs. The Dow is at the highs of the session now, even as the Federal Reserve has taken its own forecast for rate cuts down to 1 this year from 3 back in March. As is customary, we are joined exclusively by Jeffrey Gundlach. Only today we are live in Los Angeles with the CEO, CIO, and founder of DoubleLine Capital. Thanks for having us here. It's good to see you.
Thanks for coming, Scott.
So what do you make of what you saw and, more importantly, what you just heard? Then big news, obviously, is the forecast down to 1 cut from the 3 we had in March.
That's right. I think that's what will be remembered in this meeting, in the history books. In past meetings, there was new ideas that were brought out. Remember, we had supercore inflation was brought out at one meeting. There was 3-month and 6-month annualized was brought out. This one, they actually had to do the SEP, and so they had to adjust things a little bit. But he was remarkably vague in the Q&A session, basically saying, I don't know what's going to happen. And he did mention that he can't wait for the labor market to really show signs of weakening. He doesn't want to break things just to fix them, let them break and then fix them. But I think that's pretty contradictory. If the labor market is strong and stable, and you're not going to wait until it starts weakening, I don't see that. I don't see that to be consistent with dropping from 3 cuts to 1 cut. But the market seems to be completely focusing on his tremendous balancing act. He used the word balanced a lot of times between the labor market, which is weaker but not weak enough, and then the inflation numbers, which have kind of stalled out at about, well, it depends what you look at. There's so many different inflation numbers. But, I think that the idea of getting to 2% is really interesting. And he actually brought this up very late in the press conference, and that is that the core CPI was at 2% for a very long period of time, almost in a perfectly linear fashion. And that happened all the way until, of course, the pandemic. And then we had this spike. And so now the inflation rate is more like 2.5% for the past 20 years and almost 3% on the core PCE for the last 10 years. So you can kind of pick and choose what inflation data you look at. One way to think about it, if you're really serious about this 2% idea over the long term, and he did bring it up, you would actually need inflation for the next 10 years on the core CPI to be 1% per annum to get us to a 20-year run, to get us back to that 2% trend that was in place pre-pandemic. So I actually think implicitly what we have here is a growing acceptance of a higher baseline inflation rate. It seems that he said 2.7 is not that bad. I think he was quoting the PCE. So I just feel like the market is very fond of the fact that hikes still sound rhetorically like they're completely not being considered.
You've said most recently you're still looking for 1 cut this year. Does that hold today, given what you saw in the data and what you just heard from the chair?
I actually think I'm less confident there'll be 1 cut this year. I almost feel like the Fed is going into a reactionary mode. They're going to react much more volatilely and quickly, I think, if the data starts to get bumpier. I just feel like he's almost a trigger finger, it seems to me, on deciding whether inflation is going to be acceptable. They can cut rates, but what if there's some other problem? I feel like he would possibly go to, in the future, Fed hike rhetoric. I think that's a potential.
Even with what he said today about the report, the CPI today being better than almost anyone expected, those were his words.
It was better than anybody expected.
Said they made good progress. We're getting good results here. He said as well. It feels like he's building the case for cuts.
Certainly, they've been tilted towards cuts ever since, I would say, November 1st, which started everything off in this rally. It was reinforced, I would say, at the last meeting, where it was quite a surprise to the market. There was a fear that there would be more talk about potential hikes, that it wasn't all skewed towards rate cuts. And I feel like that was walked back a little bit today, but you have to get out a magnifying glass and look at the rhetoric. But I don't know. I think that the labor market is weakening. It's not weakening in a way that's alarming, but the unemployment rate has been going up. The household survey looks pretty bad. I mean, part-time jobs is negative. Full-time jobs, rather, is negative year-to-date on the household survey. And he tipped his hat to the fact that we have highly contradictory data. That's because we have a highly inconsistent economy. And I think that's a theme that's been developing in commentary across the board, that some levels of the economy, those that are needs-based consumers, are getting crushed because the things that you need are still very high in price and they're not going down. It's the same thing with the money supply. We talked about this before, where the M2 was spiked dramatically in the pandemic response, and then it went negative year over year, and everyone says recession's imminent because it's negative. But the amount of money is still a lot. M2 is still way above the pre-pandemic trend. And although people focus on this excess savings theme, the fact is that the M2 money supply is growing again, and it is still way above the pre-pandemic trend. So there's still sloshing around. It's just not evenly spread in the economy.